This is week 6, monetary policy of the financial markets course. I'm here in the Yale Peabody Museum, and this huge dinosaur here, this is actually the first brontosaurus. It was discovered by O.C. Marsh at Yale University. Well, they've changed the name. Now it's called Apatosaurus. There was another dinosaur he discovered, and they decided they were the same dinosaur. And then you'll see the whole panorama of life on Earth. There's a little lesson here, I think, for finance. It's about risks. If this animal had managed its risks better, it would still be around. Well, it's also about black swan events, which we mentioned before. There was a huge collision between the Earth and an asteroid about 65 million years ago. And that's one thing you'd just think could never happen, but these things do happen, and that's an important lesson for finance. What we're talking about this week is about money and banking and central bank monetary policy. And it is really an interesting area. It's an area that has been, well, the history of banking is a history of every now and then disruptions that are devastating to an economy. And it's a history of technological advances in risk management to try to prevent these things from happening again and again. So the technological advances that we have, they go back to, in 1863, the United States passed the National Banking Act, which was supposed to prevent financial crises. Well, it worked for a while, but then we had a crisis in 1893, and then another one in 1907. So the U.S. decided it had to do something again to fix the financial system, and they created the Federal Reserve in 1913. That was modeled after European central banks, notably the Bank of England. So that worked for a while. People thought that we had solved the problem of our financial crises. But what happened? In 1929, there was another huge crisis, a major rash of bank failures. So we had to figure out something again. And then the procedures in the Federal Reserve were made more modern, and monetary policy became more enlightened, and it seemed like we had fixed the problem again. But then other crises happened. And in 2008, we had a huge financial crisis. And once again, we're trying to see how to fix the kind of crisis that we saw recently. The most recent, since 2008, governments around the world have been working on new procedures to make the financial system less vulnerable to crises. And notably, the Basel Committee that's Basel, Switzerland, is an international organization that recommends regulations, came out in 2010 and 11 with new regulations called the Basel III regulations, which are now being phased in around the world, and the phase-in is supposed to be complete by 2018. So in these lectures, we're going to talk about the basic financial problem and this recurrence of problems and why they happen. And we'll talk about the Basel III solutions and about the importance of both reserve requirements for banks and capital requirements for banks. We try to understand what exactly these are and how they might help, if they're managed right, to prevent financial crises like this. So we have then, at the end of this week, we have a guest lecturer, Lawrence Summers, who is a professor at Harvard University, former president of Harvard University, former U.S. Treasury Secretary, who is reflecting on, it was part of the Arthur Okun lecture series here at Yale, and I had my class all go to this because I thought it really fits in well with the lectures in this course. He reflects on the nature of financial crises that we've seen since around 1980. He has a list of 7 major crises around the world, starting with 1987, the worldwide stock market crash of 1987. And he argues that the nature of crises is changing, that these crises don't look like the 19th century or the early 20th century crises. And that's why they catch regulators off guard. There's something that he says about the extraordinary success of our policies that led to a different sort of crisis. He gives an example of how medical research has largely eliminated infectious diseases as a cause of death. But then what do we see? We see cancer deaths rising. Well, that's because, if you don't die from something, you go to die from something else. So it's like that with our successful policy. The innovations to stabilize the banking sector in the past have made it so stable that it goes a long time. There's something called the Great Moderation from after World War II until around 2000, when there were relatively few, until 1980, relatively few financial crises. And then they started to come back in a different form. And part of it is complacency, as Summers argues, and as I would argue, that part of what happens is once we have very good regulations, people start taking risks in different dimensions because they think, well, everything is solved. But what this means to me is that the financial regulations that we have are critically important, and it's critically important to constantly update them. Technology is always advancing. Financial technology is advancing to make the world a better place if it's regulated properly. But regulating these properly means watching out for hazards, including hazards that haven't happened in decades. We have to be vigilant and understand what the sources of risks are. And that's what these lectures are about.